11:47 on a Sunday night, and the phones won't stop. A bank with $41 billion in deposits is going to open Monday morning and not be able to pay them out. You've got 6 hours to decide if it still exists by breakfast, and the 7 people in this room are the only ones on earth who know. Somewhere out there, someone who banks there is asleep right now. Sure, their paycheck lands Friday like it always does. Whether it does is being decided here, tonight, by people they'll never meet. Nobody outside this building has heard the word crisis yet. Do your job right, and nobody ever will. The rent you paid on time last month, the loan rate you signed without a second thought, the paycheck that hit your account 3 Fridays ago, all of it was quietly backstopped by rooms like this one, on nights like this one, that you were never told about. Here's what actually happens in the 6 hours before a crisis either happens or quietly doesn't. The first 2 hours are just numbers, and they come faster than anyone can take them in. The run started Friday afternoon. Depositors pulled $6 billion in 9 hours after a rumor about the bank's commercial real estate exposure started on a message board. The rumor wasn't even right. Didn't matter. $6 billion left anyway, because a rumor about a bank doesn't have to be true to come true. What's left in the vault covers about 11 hours of a normal Monday. And Monday is not going to be normal, because word of a run always moves faster than the run. Look around the room while the numbers load. 7 people. The duty officer who took the first call. A lawyer already reading the statute on her phone. Someone from the deposit insurance side, someone from the markets desk, and the 2 who will actually sign. None of them plan to be here tonight. All of them have done a version of this before. You pull up the exposure map. 41 billion in deposits, but that's not the number that matters. 19 billion of it is uninsured, sitting above the $250,000 guarantee, and most of it belongs to small businesses making payroll Monday and Tuesday. Bank can't pay. They can't pay their people. The call puts it at 4,000 companies, 60,000 paychecks. Gone by Wednesday if this isn't fixed by 6 a.m. Pull one company off the list at random, and it's a logistics outfit with 900 employees and a payroll run that clears at 9 a.m. Monday. 900 people who did nothing wrong, about to not get paid because of a message board post on a Friday. Then the second number lands, and it changes the room. 3 other banks, unrelated on paper, share enough of the same depositors that a public failure tonight has a modeled 70% chance of starting runs at all 3 by Tuesday. Not certain, modeled. But modeled by people who've called this exact chain reaction right twice before, so the room treats it as good as certain. This isn't about one bank anymore. It's about whether Monday morning, across a whole region, everyone with a checking account figures out at the same moment that the system runs on confidence, not cash. A third number shows up before 2 a.m., and it's the quietest one: overnight lending. The way banks lend each other cash to cover a shortfall has already frozen around the failing bank. 3 banks that would normally hand over the money without blinking turned it down an hour ago, not because they know something you don't, because saying no costs them nothing, and saying yes costs them everything if the rumor's true. That no is data. Everyone on the call reads it the same way. The market already decided, hours before it opens. And here's the trap underneath it. There's an official lender of last resort the bank could go to, a window it can borrow from when no one else will lend. But borrowing from it is a signal. The moment word gets out that a bank tapped the window, everyone reads it as proof the bank is drowning, and the run gets worse, not better. So the tool built to save a bank in exactly this spot is the one thing it can't be seen using, which is why the decision lands back in this room, at this table, at 2 in the morning. The part of the job that gets to you settles in around 1 a.m. when you realize that if you get this right, those 4,000 companies will never know how close they came, and the crisis that didn't happen will never get reported by anyone, ever. By 2 a.m., the options are on the table, and every one of them comes back to the same 60,000 paychecks. Hold on to that number while the rest gets complicated, because it's the only thing in the room that isn't abstract. Option 1. Let the bank fail, publicly, this week. Insured depositors get made whole by the guarantee fund. Uninsured ones eat a loss, 40 to 60 cents on every dollar over the limit. This is what the rulebook says should happen. A badly run bank made bad bets, and the people who lent it money, some of whom should have known better, take the hit. Clean, defensible in a hearing. Exactly how the textbook draws it up. Option 2. Open an emergency lending facility at midnight so the bank can pay every depositor in full Monday morning, insured or not, while regulators go find someone to buy it. Here's how that actually works. Because the mechanics matter. You don't hand the bank cash. You lend against its assets, and you mark those assets down first, a haircut, so a loan booked at $1 might only get you 90 cents against it, at a penalty rate north of 6%. There's a name for this inside the building that never makes it into a press release. Extend and pretend. It doesn't fix anything. It buys 3 weeks the bank still can't survive on its own, betting a healthier bank swallows it before the clock runs out. The lawyer pushes back, and she's not wrong. The rulebook exists for a reason. Save this bank tonight, and you teach it nothing, and you teach the next one watching even less. Let it hurt, visibly, once, and maybe the next bank thinks twice before making the same bet. She says it plainly, and for a minute the room actually sits with it, because everyone knows she's right in principle. Then someone puts the 70% number back on the screen, and being right in principle stops mattering. The math is simple and ugly. The facility costs the system about $200 million over 3 weeks. The 70% scenario, 4 banks running by Wednesday, costs a number with a comma somewhere that makes the room go quiet. Someone says the counterfactual out loud, the way someone always does. If those 3 go too, the combined uninsured exposure across all 4 is near $11 billion, big enough that the insurance fund itself starts getting questioned in public for the first time in over a decade. $200 million against that isn't a close call, whatever it looks like from outside. 2:17 a.m., the call is made, because the math on the page barely leaves you one. Nobody says the quiet part, because everyone already knows it, and saying it wouldn't change tonight. The bank you're about to save made the same commercial real estate bets that blew up 18 months ago at a different bank you also saved, because every rescue that works makes the next reckless bet a little more likely. There's no dramatic moment when it happens. No vote, no gavel. 2 people initial a document, a term sheet goes out to the failing bank's lawyers, and a wire instruction gets queued to send the second the system's open. That's it. The biggest financial decision most people in the region will never hear about gets made the way you'd approve an expense report. By 4 a.m., the facility's live, moving through channels the public won't see for months, if ever. The bank's executives get the call at 4:30. Several of them keep their jobs, at least for now. Monday morning, the bank opens on time. Tellers process withdrawals like it's nothing. A payroll company runs $412 million through its accounts without a hitch, never knowing that transfer nearly bounced at 3 a.m. 60,000 paychecks clear. Those 900 logistics workers get paid at 9 a.m. and never hear a word about any of it. Nobody out there feels anything but an ordinary Monday, which is the whole point, and also the problem, because an ordinary Monday teaches every other bank watching that the floor is softer than the rulebook says. 3 weeks later, it ends the way these usually do. A bank, twice the size, buys the failing one for almost nothing, a token price, and takes on the deposits. And notice who had the leverage in that deal. The buyer knew the regulators needed a buyer more than it needed to buy, so it named its terms, took the good loans, left the worst ones for the government to clean up, and paid a price that would have been unthinkable a month earlier. The rescue that saved the region also handed one already large bank a bargain and made it bigger. Nobody planned that. It's just what falls out the back end of a night like this one. The facility gets repaid with the penalty interest, so on paper, the system even makes a small profit on the rescue. And that's the part that leaks. Because the CEO who ran the bank into the ground walks away with a payout written into a contract years earlier. And when a regulatory filing surfaces that number in a footnote months from now, the anger aims straight at it. Not at the $11 billion the whole thing prevented. At the payout. And the 200 million. The two numbers small enough to fit in a headline. You go home at 6, wrecked, and you're back at your desk by 9, because those 3 banks are still being watched, and one of them is already showing the first signs of the same rumor. You'll probably do this again inside a year. For a bank that took on risk it might have skipped if last year's rescue had been allowed to hurt where people could see it. You know that. Everyone in the room knew it, and nobody said it, because saying it wouldn't move a single number. The call gets made anyway, every time, because the other option tonight was 60,000 missed paychecks by Wednesday, and that was never abstract to anyone holding the pen. The crisis you stopped will never make a headline, because the only proof it almost happened is a room full of people who can't talk about it, and a Monday that felt like nothing. 3 things this should change about how you read the news. When a bank failure actually makes it to the news, it means the quiet saves already failed, or somebody decided the save wasn't worth it this time. The failures you hear about aren't the norm. They're the ones that got past a room like the one running at 11:47 that Sunday. Keep your deposits under 250,000 at any one bank. That's the line the whole night was drawn around. If you run a business holding more than that for payroll, split it across banks, or use a cash sweep account that spreads it for you, because that uninsured piece above the line is the exact number that decides whether you're the 900 people who nearly missed payroll or the ones who never found out they almost did. Watch for banks that keep getting quietly rescued instead of failing, because the pattern tells you something. Saved once might be bad luck. Saved twice means a room somewhere ran out of better options. 60,000 people got paid on a Tuesday they'll never know was in doubt. Somewhere tonight, in another building, on another quiet Sunday, a phone is already lighting up, and nobody getting paid this week will ever be told how close it came, at 11:47, to not clearing at all.